We have Vasili here today, and he's going to be talking about financial planning for home ownership. So I'll let you take it over.
Thank you. Thank you. Well, hello, everyone. Thanks for coming. Yeah, as Brandy mentioned, I'm going to be talking about financial planning for homeownership. So we'll get right into it. So I'm not going to spend too much time introducing myself, but very, very quick slide. I'm Vasili Zois. I'm one of the owners of Meritum Advisors. So we're actually 3 firms in one. We have an investment practice, so we do all of our investments in financial planning. We have a tax and accounting firm, and we also have an insurance agency, all wrapped in one firm. So whether people want to utilize us or need help with all of those, or just maybe one of those, we can help them in all those different facets. But what we're talking about today is financial planning for homeownership. So some of the things that we're going to be talking about is renting versus buying, building wealth with real estate, assessing your financial readiness to buy a home, cost associated with homeownership, the home buying process, budgeting for homeownership, common mistakes that I see, building home equity, and how taxes are affected with owning homes. So here is just a quick comparison of some of the pros and cons with renting versus owning. So in my field with financial planning, I believe that everything has a pro and a con. Every decision that you make in your life, there's always an advantage, and there's always a disadvantage. And what I help people do is basically just weigh those to determine what's best for their actual needs. So there are some advantages of renting. So you have flexibility and mobility. So if you're always on the go, or if you don't know if you're going to be in a certain spot for a long time, it might be a good option. Lower upfront costs. Typically, when you rent, you just have to put down a security deposit, maybe first and last month's rent. No maintenance costs. Typically, your landlord will handle all repairs and anything that needs to be done on the property. And predictable short-term budget. So obviously, you just have a fixed monthly rent cost, and that's pretty much it. Now, the disadvantages are your rent doesn't gain any equity over time. So really, you're not building any wealth through that. Rents typically increase because of inflation. So it's not guaranteed. I mean, if you're a good long-term tenant, maybe you can work something out with your landlord, but typically rents increase over time. Limited control, unless you have a really nice landlord or they agree to the change that you want to make for your unit. Typically, you can't really customize or renovate the property. And there's no tax benefits or write-offs or anything for renting the property for yourself. There is for the owner, but you as a renter cannot. Now, owning, on the other hand, again, just advantages and disadvantages. So the first one, obviously the big one, is you own an asset at that point. So you get to build, it's an investment, you get to build equity, you actually have ownership in that. And it's an appreciating asset. So hopefully your home value goes up over time. Stability. So again, with rent, it is potential to increase over time, but with a mortgage payment, you're pretty much locked in for the most part, depending on the mortgage you get. It's a fixed mortgage cost, ongoing. Again, you own the property, so you have the freedom to customize it however you want, renovate it, truly make it your own. And depending on how you file taxes and everything, there's potentially tax deductions and tax write-offs as well. Now, disadvantages to owning: higher upfront cost. You have to save for a down payment, and there's closing costs involved. Things can happen, maintenance and repairs, so you have to foot that bill as well. A little bit lower flexibility. I mean, if the market's good, you can sell quick, but generally selling and moving take a little bit longer than a rental contract. And then this isn't a huge factor, but technically you have a risk of depreciation. I mean, if the property values in that area go down, yours might go down as well. But typically that's not the case. Typically, historically, things continue to go up. So building wealth with real estate, as I mentioned before, if you own the asset, you're building equity, which we'll go over a little bit later. But just to share kind of some stats here, homeowners have significantly higher net worth than renters, with the median homeowner's net worth being approximately 43 times greater than the median renters. And that's just a comparison for 2025, is generally homeowners have a net worth of the median is 430,000 versus renters at just 10,000. So obviously that's a huge difference there. And then it's a pretty dated quote, but it still holds pretty true. Is 90% of all millionaires become so through owning real estate. More money has been made in real estate than any industrial investment combined. The wise young man or woman or wage earner should invest his or her money in real estate. So that's Andrew Carnegie. That quote's over 100 years old, but again, it is true that owning land or property or something does help build wealth over time because generally speaking, it appreciates.
I had to ask, does
Yeah.
that quote originally have "or woman" in there?
No,
Or
I
did you?
added that because it's modern times.
Thank you for that.
Yes. So, assessing financial readiness. So, before you begin your homeownership journey, it's important to assess your personal financial readiness. A big mistake that I see people make, and again, I'll cover more mistakes later, but is jumping in too soon or purchasing more house that they can afford and not having the adequate savings for emergencies. So, a couple things to evaluate before you determine if it's the right time to buy or not. There's a couple things. First off, your income stability and your employment status. So is your income and employment status sufficient to afford the house that you want? Is your income stable? Do you have W-2 or are you a self-employed person? Like you have fluctuating income. Another thing is debt to income ratio. It's important for getting a mortgage. That's typically one of the big factors they look at. And it's basically a percentage of your total debt compared to your income. And again, depending on the type of loan and everything like that, there's a range, but typically they want it to be below 40, 50%, somewhere between there. But that's on the lender side of things. Your credit score. So the credit score affects the loan terms and the interest rate. So the higher the score you have, typically the lower the interest rate. And do you have adequate savings? Do you have enough saved for a down payment? Do you have enough cash reserves to cover emergencies and maintenance or job loss or any of that type of stuff? So here's a couple things to evaluate on a personal level to determine if you are ready to make that jump. So what are some of the costs associated with owning a home? So there's two. There's the during the purchase or when you're purchasing, and then there's everything that comes after the fact. So during the home purchase or when you're in the process of purchasing a home, you have the mortgage down payment. It can be as little as 3%. A lot of people still think in their head that you have to have 20% down, but it can be as little as 3% for most programs, or for VA and USDA loans, there's some that's even zero down. But again, that's more on the lender side of things. You have the inspection cost, which hopefully John can help here, but I think it typically ranges between $300 and $500. Again, it depends on a lot of different things, but it's important to know what you're buying and to protect the asset that you're buying because it's a huge investment. And then you have the closing costs that typically, again, it ranges, but it's typically between 2 and 5% of the total purchase price. Sometimes you can negotiate it. Maybe you want a Brandy can help negotiate something with the seller, but there is a cost when you have to close as well. So, and sometimes that includes the down payment all in one. But again, there is a large chunk that you may have to put down when you initially purchase the home. So obviously you should factor that in when planning in your financial readiness. Now, there's costs after the fact too. Again, if you're renting, you just have the fixed cost. You don't really have to worry about mortgage payments and all this other type of stuff. But if you want to be a homeowner, there's additional costs as well. So of course you have the mortgage payment, which typically is your principal, your interest, and your PMI. So PMI is mortgage insurance. If you don't put more than, or if you put less than 20% down, typically there's some sort of PMI. The mortgage payment often also includes insurance and property taxes, but it doesn't have to. You can pay those separate. You need insurance as well. Obviously, you want to protect the large investment that you just put in or that you just purchased. And it's almost always required on the mortgage side because obviously they want to protect themselves as well. You have your property taxes. So property taxes will vary depending on your city, municipality, county, township, school district, everything like that. So that's important to factor in when you're looking for a home in a certain area. This isn't applicable to everybody, but if you are in like a condo association or townhomes like what I live in, we have an HOA, a homeowners association. So there's an extra fee for that per month. And again, it varies per community. But that, and again, it varies, but it could cover landscaping, signage, if it has a pool or a gym, or there's a big tower building behind me, they have an elevator, so it helps to cover the maintenance of that. Again, every property is different. And then you have the maintenance and the repairs. So what happens if a water heater breaks, or a heater, or roof repairs, or interior cosmetics, or even just renovations? I mean, I'm in the process of repainting my house and doing a couple of renovations myself. So again, that's a cost, but again, it's building up property value and everything like that. So there is a reward on that. I'm not gonna go in super over this, but I will just quickly highlight it because obviously you have Ioana and Brandy for that. But what does the process look like? Number one, you have to decide that you're ready. I always tell people, don't time the market. It kind of goes in the same thing with investments like stocks and bonds and stuff like that. Don't try to time the market because no one has the crystal ball. You never know what interest rates are going to do or what the home prices are going to do. But really, just decide on what is the best for your specific needs. I mean, if you're having kids and you outgrew your house, I mean, that's a need. You might need to move, or if you want to go into a certain school district, or if your job's moving you or something, obviously that's a need. And then two, assess the financial readiness. We went over that a couple slides ago. The income stability, debt to income ratio, credit score, and your personal finances and your savings. Hire a real estate agent. Obviously, you guys have Ioana and Brenda for that one. Mortgage lender pre-approval. This is like a formal and verified step that confirms your credit worthiness. So it's important to get one of those before you go shopping for a home because it'll let you know how much you can comfortably afford. And when they're submitting an offer on your behalf, it builds credibility, and obviously it's just good to it's a good way to vouch basically that you can get pre-approved and you've done the due diligence before you are out there just shopping for homes randomly. Then you can actually shop for the homes, and again, Brandy and Ioana will help you see what fits your budget, your wants, your locations. They'll help you go through all of that. They'll help you submit an offer and negotiate the home price. You have the inspection and the appraisal. Again, hopefully John or someone else can help with that. But again, it's nice to know what's maybe wrong or what needs attention in the home. And the appraisal obviously makes sure that the house is valued at what it's at. You're not overpaying or anything like that. And then you close on the home and you're a new homeowner. So that's awesome. Again, just very quick process on the home buying process. So you can be aware of that. So budgeting for home ownership. So very first thing is create a budget and a timeline. So just how long will it take you to be ready for a home purchase? You might already have ample savings and you may be able to pull the trigger on a relatively soon timeline. Or it might be something that you're thinking about in the future and you need to start actively putting money aside or making some moves to make that happen. And again, purchase when the time is right for you. Don't just try to time the market and wait till rates drop because they've been saying that for years now, or when the home prices are going to drop. Just really when you really need to, or you feel like it's right, just do it, and you can always refinance or figure things out later. But yeah. And then figure out how you're going to save for that. So there's a couple options, obviously. First one is you can just save money at a bank. If you're going to do that option, I at least recommend doing like a high yield savings account or a money market account so you can earn a little bit more interest than just like a normal checking or savings account. I think high yield savings accounts are paying like 3 to 4% on the high end. I think it's like 3.2, 3.4 right now. But again, it's a good safe option that's FDIC insured. Yeah, but again, you don't get a ton of growth there, so it might take you a little bit longer to save. Another option that can maybe help you grow a little bit quicker, but there are some downsides, again, disadvantages to everything. You can open up like a brokerage investment account, and you can invest a little bit more conservatively still, maybe still get more growth than like the 3 or 4% at the bank. But the downside is nothing's guaranteed and it might fluctuate. And one, it might fluctuate. So if you're ready to buy a house and then all of a sudden maybe the market tanks or investments go bad or something and it's worth a little bit less than what you thought it's going to be, obviously that's a downside. So there is some risk with that. And also because it's not like a retirement account or something, when it comes time to sell those investments to purchase the home, there may be a little bit of tax on any gains or anything like that may be owed. But again, it's just an option to consider. Another one is, just give me one moment here. Another option is a gift or an inheritance. So some people get gifts from their parents or a grandparent, or they inherit assets, or they even get a loan from parents. I know a lot of people that do that, and then to help with the down payment and those upfront costs, and then they either, again, it's either a gift or they come to some agreement with the parent or a relative to pay that back over time. And then the other option is retirement savings. Again, pros and cons with this, but there's a couple options with this. So if you're working, or if you have IRAs or 401ks, you can touch a portion of it. So if you have an IRA, an individual retirement account, if you're a first-time home buyer, you can withdraw 10% penalty free. So typically with retirement accounts, you have to be at least 59 and a half to access those funds without paying any additional penalties. Or tax or anything like that. But if you're a first time home buyer, you can get that money without the penalty up to $10,000. So that could help. But again, you are borrowing against kind of your future retirement there. So there is a disadvantage to that. Or if you have a 401k through your employer, and if your employer plan allows it, you can actually take a loan against your policy and then just pay that back over time. This is nice because you also avoid the tax and the penalties, and you're just paying yourself, your future self, back over time as well. And usually the payback is generous. So I know a lot of people that have done that. I have a couple clients that have done that to buy investment properties and stuff, and then just over the course of time, they kind of pay that back because they have time for retirement. So just another thing to consider. I apologize. Give me one moment here. Got a little helper here, and he's chewing on puzzle pieces. All right. So a couple common mistakes that I see people make. House hunting before getting a pre-approval letter. So again, if you don't actually talk to a lender and you don't get that pre-approval letter, you don't really know how much house you can afford, or you might not even get your offer accepted, really. So you kind of need that pre-approval letter nowadays to get a offer accepted, and again, just to make sure that you're not, to actually make the deal go through, because you don't want to start the process and then get halfway through and then the lender say, oh, you know what, you can't actually you can't afford that much house, and then you have to back out of the deal and start the whole process over. Assuming you need a 20% down payment is another one big common mistake. That was kind of the industry standard for a while, but again, there's a lot of loan programs out there where you can do it for much, much, much less. So again, talk to Brandy and Ioana, talk to a good mortgage lender, and they can help you get in a home for a lot cheaper than that. I've said this a couple times, but trying to time the market, again, buy when you need or want to. Don't worry about the house prices or the interest rates. Everything will work out one way or another. Again, just do it when it's best for you. Making a decision based on strictly emotions. Obviously, emotions are important, but just try to stick to reality as well. Don't force something if it's not really meant to be. Sometimes then you will think hindsight 2020. It's good that maybe something didn't work out, but it's good to balance the emotions and the logic at the same time. Buying more house than you can afford. Again, just like anything in finances, live below your means. You don't want to be house asset rich but cash poor, because something happens, all of a sudden you can't afford it. Again, it's just a nightmare. So stay within your means. A lender will tell you this as well. Same with Brandy and Ioana. Making other big purchases before you close. During that process, typically 30, 45 days, however long it takes to close. Don't go buying a new car, opening up credit cards, or changing jobs or anything huge, because that might derail the whole deal, and it might red flags for the lender and your credit score and all that type of stuff. So just hold off. Obviously, you probably don't want to be spending that much money all at once anyways, but again, just if you don't have to, don't do it. Not researching your loan options. Again, they'll be able to steer you the right way and give you a trusted loan officer, because there's tons of options out there. They're constantly changing, just like everything else. So they'll be able to help you get the best deal out there. Failing to maintain a rainy day fund. So again, things happen, especially when you own a home. You never know when a water heater is going to break, or a leak in the basement, or a roof, or again, there's always something. So it's just nice to have a rainy day fund. And not only for repairs. I mean, there's job loss. There's things that happen where you want to make sure your mortgage is paid and everything. So it's always good to just have some sort of an emergency fund. And you hear the rules of thumb. People say it's 3 months, some it's 6 months, some a year. Everybody has a different goal or a different threshold that they want to meet. So whatever just makes sense for you, but at some sort of rainy day fund. And then missing out on assistance programs. Again, you may qualify for different assistance programs, down payment assistance programs, or different loan programs. And if you don't research or if you don't work with good qualified professionals to help guide you, you might just be missing out on money or extra benefits you're not aware of. So building and accessing home equity. So this is the wealth building with real estate. So there's two ways really to build equity in real estate. The first is through your mortgage payments. So when you get a loan, you put a down payment down. The rest is a loan from the bank. Over time, that loan gets paid down. You're basically building up equity in that property, building up principal or equity, whatever you want to call it. So that's one way. Obviously, your loan, the amount that you owe back to the bank is less. The amount of money that you've paid in is more. So that's your bucket that is yours. And then the second one is appreciation of home value. So again, home values typically go up over time. So if you sell your house for more than what when you owe back to the mortgage or the bank, you get to keep that when you walk away. And I'll just use a real life example. I'll use this townhome. We purchased it about 5 years ago for $300,000, and these are rough numbers. We put down $20,000, so the loan amount was $280,000. So again, I think that's like 6% or something. So again, that's to prove my point again, where you don't have to put 20% down. You can do it for much less. One of our townhomes just sold last Friday for $480,000. Right now, if we owe $260,000 still on the mortgage. So if we were to sell it at that same purchase price or selling price, we would have $220,000 left over. So again, that's extra equity that was built in because of the house prices have gone up over the past 5 years. So that's just another way to look at it. We've paid down basically $20,000 on our mortgage. So that's extra equity right there, plus the extra gain of the home value. So two ways really to build equity in wealth building in real estate. And then there's there's a couple other ways, but there's three main ways to access the equity. So the first one is a home equity line of credit. You can do this through a bank. Basically, you go to a bank and they do like a revolving line of credit secured by your home's equity. So let's say I wanted a HELOC, home equity line of credit, on that $220,000 that's kind of floating out there in the ether. I could go open up a HELOC with a bank. They would secure it with my home's equity or my home mortgage. And I could access that revolving and get access to that as like a second mortgage or another line of credit if I needed it for home renovations or basically for other things. So I can access that without selling my home or completely refinancing. You can do what's called a home equity line of credit. There's also a cash out refinance option. So you can replace your existing mortgage with a new, larger loan based on the new property value. And then I can convert some of that equity into like a lump sum payment. So this is really common with rentals and investment properties. Some people will buy a property, invest some money into it, fix it up. It's worth more then they cash out refinance and pull out the equity that way. And then the third way is just selling and downsizing. So, I mean, if you sell your house and you purchase a cheaper home, you have leftover equity in cash between the sales, and that's money to walk away with or reinvest or use for other things. And I see it a lot with retiree clients. They either have their house paid off in retirement, and then they just don't have those payments anymore. Of course, they're still going to have interest in property taxes, but they don't have those mortgage payments. Or they realize, you know what, my kids are grown, or I don't need this size house anymore, and they downsize to a patio home or a single story, or again, they just downsize in general, and they purchase a cheaper home, and they have leftover. And again, they can use that for retirement or use it for other things. So it's just building wealth, or you can pass it down to grandchildren or children or heirs, or again, whatever. And then I think we're getting to the end here, but how are taxes affected by all of this? So if you're a homeowner, you can potentially deduct some house-related expenses. If you're an investor, you can actually deduct a lot more. But if you're just a homeowner and it's your primary residence, you can deduct a couple house-related expenses. The big ones are state and local real estate taxes, or sometimes it's called the SALT tax. State and real estate tax. So the limit used to be $10,000. They just raised it to $40,000. That's the limit up until 2029, and then it's going to go back down to that $10,000 limit. Um, you can also deduct home mortgage interest on up to $750,000 of mortgage debt. And then you can also deduct primary mortgage insurance. That's the PMI that I mentioned earlier. But there is a phase out for that. So if you do, you have to earn your adjusted gross income must be below $100,000. And then it completely phases out. You're not allowed to write any of that off if you surpass 110,000. You can only claim these if you itemize your deductions. There is the standard deduction as well. So really you just have to work with the tax professional, us or someone else, to determine what's more. I mean, if it makes more sense and your state and local taxes and your PMI and your home insurance or your mortgage interest are more than the standard deduction, plus charitable giving and all the other things you might have. Obviously, it's better to go that route. Or if the standard deduction is higher, you claim that. Again, a tax professional can help you determine what's the best for your tax savings. Now, things you can't deduct are pretty much everything else: insurance, depreciation, cost of utilities, clothing costs, internet, HOA fees, home repairs, things like that. Now, again, if you're an investor and you buy and you own it for an investment property, you can write those off. But if you're just a primary, if you own a property for your primary residence and live in it, the three above only apply to you. Yeah, and I think that's actually it.
Cool. Can I ask you a question about taxes?
Yeah.
Since it's tax season, can you talk about how like purchases impact your taxes for the year after you purchase or the year you purchase? So like when you buy or if you sell, what are the tax implications? And then I also have one client who is looking at making like gifting the property to his daughter. So what would the tax implications of the gift be on both sides too?
Yeah, that's a great question. So and I'll answer them both. So the first one, I believe, if I recall correctly, is you're basically saying what happens when you sell a property for like a gain? What are the taxes on that? And good question. If it's a primary residence, and I apologize, I don't know the threshold exactly off the top of my head because they change from year to year. However, there is a threshold where you don't have to pay. If it's a primary residence and you've lived within a certain time frame, you don't have to pay gains, or there's a certain limit that you don't have to pay any taxes on, which is it's pretty large. So it's nice that you can move from house to house. And actually, a lot of people, that is an investment strategy in itself, where I know people that actually they build or they buy a house, they renovate it, they live in it for that threshold for the amount of time that's required by the IRS, and then they move and they have a significant gain, and then they move and they do that every couple of years, and it's just tax-free wealth building the whole time. So that's a very good question. I know a couple of people that actually do that. And then the second question is inheritances, and it's very common, especially with elderly individuals, where they say, "Oh, I want to gift a house." It's not necessarily and again, I hate to say it depends, and it's based on everyone's individual scenario, but it truly is, because typically it's best to not gift, because there is a large taxable gain transferred to that person that's receiving it. Whereas if they were to just hold on, because a very common example is there's an elderly individual and they're nearing the end of their life, and they say, you know what, I want to just gift this home while I'm still alive to my son or grandchild or whatever. And it's not necessarily smart to do that, because they probably bought the house for, let's say, 60 grand, and now it's worth $500,000. That's a huge gain that the child is going to have to pay on, or whoever's inheriting it. It's best to just wait until the individual unfortunately passes away, because the person inheriting that house gets what's called a step-up cost basis. So when they inherit that house, they get it as if they bought it at that price on the day of death. So let's say that house is now worth $500,000. It's transferred to their name. It's as if they purchased that house at $500,000. So if they sell it for $500,000, there's no gain, and they technically inherit that house tax-free. So, the
tax impact doesn't happen to the receiver until they sell it. Is that what you're saying? They wouldn't have to pay it. a tax on the asset, like acquiring the asset.
You're
When-
assuming if they actually
Do the gift.
gifted it, do the
Yeah.
gift. No, if they do the gift, there is a taxable gain when
Oh,
it's transferred.
okay.
It's best to just wait. Again, this is also like an estate planning question, so it's
Yes.
always good to consult like an estate planning attorney, because again, it's super specific on a lot of other factors as well. So sometimes it's best to do it through trusts or LLCs or other aspects. But yeah, generally, and I actually just had that call happen where someone was basically in hospice and like a couple days to live, and they were like wanting to gift the house, and the attorney just wanted to run by it through me as well because there was a couple other scenarios to play out, but we both agreed that it was probably just best to, especially because there was literally days, and by the time they try to do paperwork and all that stuff, it might have been more of a headache anyways. But again, and it's the same with investment accounts as well, like regular brokerage accounts. Like if you buy a stock, again, if you buy, let's say your grandmother bought $10,000 of P&G stock way back when, and now it's worth $1 million. Same thing. It's not really best to gift that because there's tax implications. It's best to just wait and let it be inherited. And again, you can do it through estate planning attorneys to make it an easier process. But you get that step up cost basis, so they can just sell that asset the day they receive it, upon death. Unfortunately, whenever the individual passes away, they inherit it that day and they get that value. So they can just sell it all and it's all tax free at that point. So sorry, that's a long answer to that question. And
No, that's helpful. Thank you.
yeah, but it's a super common question because there are people that are like, oh, I'll just gift a house and there are scenarios where it does make sense, but yeah.
There are home office deductions, right?
Yes. Yeah. I didn't really go into that because I didn't want to talk about like self-employed
I'm sure
stuff.
we've all got home offices.
Yeah.
Yep.
Okay.
Exactly. So yeah, yeah.
Yeah, I hope so, because I've been doing it for a long time.
No. I just didn't bring that up because again, I don't know how many individuals are actually self-employed or anything. But yes, technically, yes, there is, and there's two different calculations you can use. There's a simple method where they basically, and it's the same with like mileage for your car. They basically say, okay, here's the fixed dollar amount up to the square footage, and you can just take that clean and not really have to do much reporting. Or if you want to do actual expenses, then you actually have to obviously do more calculations in the receipts and everything. But no, it's a great point. Again, I just didn't really include it because for most individuals, it doesn't apply, but
yeah. Thank you.
Yeah.
I have a question.
Yes.
For buyers that are struggling to save, what do you think it would be the biggest opportunity for them to like free up cash, or you have any like suggestions on?
Yeah, it's I hate to go really to the basics, but it's budgeting 101. I mean, it's literally, and it's funny because I'm going to make a YouTube video on this shortly. It's literally just like the secrets of building wealth, but it's not really a secret. It's literally comes down to like two main things, but four if you want to expand a little bit more. The basic is just increase your income and cut your expenses. And I hate to really be that basic, but it is true. It's literally just find out ways to increase your income, whether it's changing jobs or trying to get a raise or doing some side hustles or anything. So that's one way. And then obviously cutting expenses, you have extra surplus there. And then the other two technically would be like reduce your taxes, obviously get creative on ways to, but if you're a W-2 employee, it's a little bit harder. But if you are self-employed, obviously get creative and do things by the book, but reduce your income as much as possible. And then the other one is obviously try to grow your money more, try to get a higher return through an investment. But again, you don't want to be gambling either. You don't want to be throwing it all in cryptocurrency or trying to day trade because you can obviously lose a lot of money that way too. So, but the big mystery is obviously just spend less and make more.
If you're a W-2 employee, I feel like it's always a good idea to have a little like consulting or side hustle gig so that you can take all those self-employment tax deductions too. It really helps.
Yeah. But yeah, sometimes it's unfortunate, but you just have to put a little bit aside. And it's always the thing too, where people say, you know what, I'll save more when I make more, but that's never going to be the case because things are always going to become more expensive. There's always going to be an expense that comes up. You're always going to want something new, or if you have kids, it's more expensive. Like there's always going to be something else. So it's like, you'd be surprised how out of sight, out of mind it is. And then all of a sudden you say, oh, wow, like I have all this money sitting here that I didn't think about. And there's, but it's budgeting 101 and everybody's different. I know some people have one account for everything. I know I personally like to have little buckets and just kind of put money aside. That's
To
the
like pay
financial,
yourself every month or
Yeah.
something like that. Yeah.
yeah, for certain goals and stuff. So I know things are set aside for certain things.
Yeah.
And it was funny because, so I'm Greek, just like you want, and I go to Greece every year for vacation. And when I just graduated college, again, I grew up going to Greece every summer. And when I graduated college, I made it a point to still go every summer as long as I had the means to. And so I saved money in a separate little account throughout the year. And then I would just drain it to go to Greece. And all my friends thought I was just so rich and had a high paying job and stuff. And I was like, I just budget specifically for that. I build it up and I drain the account to go, and then I build it up and drain it. And that's my vacation fund every year. So
that's smart.
out of sight, out of mind.
Can you talk more about your website and your YouTube videos?
Yeah. So our website is maritimeadvisors.com. You can go there to find a big wealth of knowledge about our different services. Again, we do investments and financial planning, taxes and accounting, and insurance. We don't do like property casualty type of insurance, like home insurance, but we do like health insurance, life insurance, annuities, all that type of stuff, long-term care. And we have clients ranging from pretty much newborns to over 100 all over the country. In every aspect of life. But the main two people that we work with are young professionals, or main three, I should say, young professionals, business owners, and retirees, with the biggest ones being retirees and business owners. And we're super, super education focused. I've been doing this for 12 years. My dad's been doing it for 45, and we have a couple other advisors that work with us as well. But I really, really strive on education first, being a fiduciary. So we do, and I was mentioning to you, Juana, before we started, I do 2 library in-person seminars a month. And then I just started a YouTube channel where I'm going to be making videos. I have 3 videos up so far. I'm about to upload the 4th, but I'm probably 1 a week or 1 every other week about pretty much every topic you can think of regarding investments, budgeting, financial planning, real estate, taxes, insurance, estate planning, basically everything that has to do with anything money. And then also on our website, so there's an education tab at the top of our website, and if you click down, it'll say in-person seminars, YouTube videos, and then on-demand webinars. And I'm going to be doing longer form webinars, just like what we're doing here, where they're pre-recorded, and then people can go in about, again, longer form about certain topics. So I just like to give people education up front, and then if they want our services, great, we reach out. But if not, I just want to make sure people are making the right decisions. So yeah.
Awesome. Thank you. Anyone
Yeah,
else?
sorry if that was kind of quick, but just wanted to go over all that. Hopefully it helped.
Yeah. Well, thank you. I really enjoyed it, and I love the way you organized everything, and I'm taking notes.
Yeah, absolutely. Thank you.
Great. Good to meet you.
Yeah, nice meeting you too.
Thank you, Vasili.
Yeah.
Billy.
See you guys.
Bye.
All right. Bye now.